You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball, and my co-host, John McEwen. In this week's episode, we'll be discussing Boohoo, Novo Nordisk, Deutsche Post, Trainline, Anheuser-Busch and Peloton. So, John, should we kick off with Boohoo?
Yeah, so Boohoo, for anyone who doesn't know, is the AIM-listed online fashion retailer in the UK, and they had their full year results out this week, announcing that the number of active customers was up 28% to 17.8 million. They had an 8% rise in the number of items per basket, which they attributed to the pandemic. Full year revenue came in at 1.7 billion, and that's a rise of 41% compared with the previous year. And they said in the UK division, they saw a 39% rise in revenues to 945 million, and gross margins were up 50.9% from 50.3%, which they put down to an increase in basket sizes. The US division benefited from strong performances from The Pretty Little Thing, Karen Millen, and Boohoo Man, with revenues in the US up 63% to £435.1 million, with lower than expected return rates, and gross margins there were up to 59.9%. The rest of Europe sales were on a more of a mixed bag, with overall revenue growing 30% to 244.7 million. And the group had commented that it's looking to offset some of the moderate cost increases caused by Brexit through cost savings. And in Europe, the return rates were starting to normalise also. The rest of the world, sales were up 19% to £120 million, with the group citing issues with reduced air freight capacity. Overall, the group underlying profit margins were down very slightly from 8.7% to 8.6%, which they attributed to higher costs of overseas distribution due to the pandemic. Capital expenditure stood at 49.3 million, with £17 million spent on distribution centres and 73.4 million on acquisition of new brands such as Oasis, Warehouse, Burton and Debenhams. And when acquisitions of the brands and intellectual property and also the remaining stake of Pretty Little Thing are taken into account, there's a free cash outflow of 121.8 million, which compares with 70.1 million inflow last year. Net cash stood at 276 million, which is up 35.4 million, and that was helped by a 195.7 million capital raise. In terms of the valuation at the moment, the price to earnings is 29.2, and that's compared with an average of 41 since listing on the alternative investment market in 2014. Sam, what do you think of these full year results from Boohoo?
I didn't know really what to make of them, to be honest, because I thought the PE looks quite attractive, but they've had a lower rate of return, which is why I think it's almost artificially high, because it is still very much in growth mode. I was probably quite disappointed with that growth, because it's actually lower than the previous year, where they grew at about 44%. And I know 41% is still impressive, but I just think with everything that's happened in the year and that big push to online and a lot of their retail competitors being closed, I possibly would have wanted to see growth actually increasing. And the market cap's similar. They're about 20% smaller market cap than ASOS, but they've only got 52% of ASOS's sales. And ASOS is increasing revenue at 25% compared to their 41%. And I think I expected them to be putting up better numbers. One thing that is in their favour is that the operating margins are stronger than ASOS. So where they're on 8.6%, ASOS is only 5.9% at the minute. And that increased substantially in the year, whereas Boohoo's been more profitable in previous years as well. So yeah, I was probably actually a bit disappointed. What about you?
For most businesses, these would be quite impressive numbers, but I suppose the price and the industry that it's in, perhaps you would be expecting better. And then the sort of reservations about the working conditions and some of the doubtful sort of supply chains, you worry about that, I suppose, well, you might say from an ethical perspective, but then also on how that's going to, whether that's going to sort of hit the bottom line if they alienate their sort of younger, woke customers. I don't know whether that's going to be something that is going to come under a bit more scrutiny going forward. I think the acquisition of some of those high street brands, though, that's definitely a positive, and you wonder whether that'll bring in some, maybe slightly older customers. So you've got your sort of young fast fashion customers, but then also those customers who would have previously shopped on the high streets in Dorothy Perkins, Debenhams, Burton, which obviously are going to be much more nimble when they don't have the bricks and mortar to sort of drag them back, really.
Do you prefer Boohoo then, or ASOS?
I probably go for ASOS, but I don't dislike Boohoo. I don't know whether I'd buy it personally, but I think the more I've looked at both of those businesses, the more I've begun to like them. I think probably when I saw them a few years ago, I just thought that they were extraordinarily expensive, and that put me off looking at them any further. But just covering them in the results that we have done over the last 6 months, year, has been interesting, and I probably appreciate the businesses more now.
They are getting less expensive as well, though. I think that is part of the reason. Because the share prices haven't, I don't think they've, like ASOS's share price is well below its all-time high, but the profits and the growth is still continuing to pump out growth, and same with Boohoo. So they've grown into the valuations more, but of the two, I probably do prefer ASOS at the minute. But last time they both reported, I actually said that I preferred Boohoo.
It's swinging between two. Well, I suppose, I think interesting to watch. And we don't have either in the fantasy portfolio, but I wonder if we come to rejig it at all, or have any additions, whether it would be, end of the year, this year, beginning of next, whether it will be up there. I think they'd
definitely be on the list.
Contention. Yeah. Okay. So that was Boohoo. Next, what do we have?
Novo Nordisk.
Okay, do you want to give a bit of an explanation to the background? Because I'm sure it's not one that everyone will be familiar with.
So Novo Nordisk is a company that's actually listed on the Copenhagen Stock Exchange, and it's a global healthcare company engaged in diabetes care. The company is also engaged in the discovery, development, manufacturing, and marketing of pharmaceutical products. The company operates through two segments: diabetes and obesity care, and biopharmaceuticals. The company's diabetes and obesity care segment covers insulin, GLP-1, and other protein-related products such as glucagon, protein-related delivery systems and needles, and oral anti-diabetic drugs. And the company's biopharmaceutical segment covers therapy areas of haemophilia care, growth hormone therapy, and hormone replacement therapy. The products are marketed in over 180 countries, and the regional structure consists of North America and international operations. So they actually sell about 50% of all insulin worldwide.
Oh, wow. I hadn't appreciated that.
So they have come out with their Q1 results. All these figures are in Danish kroners, which for reference is worth, 1 Danish krone is worth about 12p. So I think that's what you just divide the figure by about 8, wouldn't you? Novo reported first quarter sales of 33.8 billion Danish kroners, up 7% at constant exchange rates. That reflects continued strong growth in GLP-1 diabetes treatments, partially offset by another decline in North American insulin sales and customer destocking as global trade conditions ease. Operating profits rose 3% at constant exchange rates to 15 billion. Group modestly increased full-year revenue and operating profits guidance, and also increased the share buyback program to 18 billion. Total sales across all diabetes and obesity care product lines rose 9% to 28.8 billion, and that reflects a 23% increase in GLP-1 treatments, with particularly strong growth in oral treatment, Rybelsus. Total insulin sales were flat year on year, with 5% growth on international markets, offset by a 10% decline in North American operations. Sales of obesity drug Saxenda rose 9% to 1.6 billion, driven by very strong growth in Europe, the Middle East, and Africa, which were up 18%. Biopharmaceutical sales rose 1% to 5 billion, and that reflects modest growth across both rare blood disorders and rare endocrine disorders. That reflects the launch of new haemophilia treatment, Esperoct and Refixia. They reported a modest decline in gross margins as insulin prices continue to decline in the US and an increase in sales and distribution costs as the group increased investment behind the launches of Rybelsus and Ozempic. R&D costs rose 7% as the group continues to invest in cardiovascular and obesity treatments. Free cash flow in the quarter was 9.9 billion, up from 8.3 billion a year ago. The group finished the quarter with net debt of 2 billion compared to net cash of 2.4 billion. Management now expects full-year sales to grow 6 to 10% at constant exchange rates and operating profit to grow 5 to 9%. In terms of the valuation, they're at a PE ratio of 22.9 and the prospective dividend yield is 2.2%. And it's worth mentioning that in the US, which is their biggest market, insulin pricing is under pressure, as is the pricing in the haemophilia business too. And so far, their newer products and international expansion has been offsetting that, but that's something they need to carry on being able to do. So, John, thoughts on Novo Nordisk?
I don't know a lot about the industry, but you certainly think if you've got sort of exposure to diabetes, and I appreciate it's sort of underpricing pressure, but you'd have thought with obesity globally increasing that diabetes drugs and this perhaps being the market leader in diabetes drugs, that it might be, on a sort of, from the company's point of view, a good long-term trend. But I wouldn't know.
Some more partnerships with McDonald's and Coca-Cola.
well, but honestly, I don't know enough about the company or the industry really to be able to comment. Nor do I know much about the pricing pressure that you mentioned in relation to the US market, or sort of any other sort of competitor or any other pharma companies that are competitors to it. So I wouldn't really feel I know enough to comment on it. But was there anything more that stood out for you in your analysis of it when you were reading up on and looking at the numbers for this company?
Not really. I was quite similar to you. So I thought from those results, and the PE wasn't outrageous, I thought it seemed like a nice little business. I say little business. It's actually...
roughly what's its market cap?
So I think it might be a nice big business, actually.
Well, 51% of diabetes
so
is
807 billion Danish kroner.
Yes. About 100 billion.
Yeah, almost 100 billion. So it's not a nice little business. It's a nice big business.
Big.
So really, it's probably, I'd view it quite similarly to how I viewed AstraZeneca and Glaxo last week, where I can appreciate the business is, but it just goes in the too hard pile. What I probably would say is that it seems like a business that is maybe in slightly better position than both of those. I think both of those had quite a lot of debt, and this doesn't really have the same level of debt. And it probably seemed like a business in slightly better shape than the two we looked at last week, but it still goes in the too hard pile.
Any more thoughts on it, or shall we move on to our next company?
I think I've covered the full extent of my knowledge there.
Okay. So we've got Deutsche Post next, which is listed in Europe. You probably know it better as DHL, and they released their first quarter results, reporting a revenue growth of 32.5% in their express parcels division to 5.5 billion euros. That was driven by strong volume growth and modest price increases. So operating profits in that division were up 144.5% to 961 million euros. Sales in their global forwarding and freight business rose 32.7% to 4.8 billion euros, with an increased ocean and air freight volumes combined with reduced supply, allowing for prices to be increased, and operating profits rose 59% to 167 million euros. DHL's e-commerce business had sales rising 46% to 5.1 billion euros, with particularly strong growth in the Americas, operating profits up 117 million euros from 6 million euros a year ago. Post and Parcel division in Germany saw revenues rise 15.1% to 4.6 billion euros and operating profit up 66.5% to 556 million euros. And that was despite a 4.3% decline in the letters business, which really shows the strength of the parcel volumes. Free cash flow for the quarter was 1.2 billion euros, which was up from 409 million outflow a year ago. and net debt fell from 12.9 billion to 11.8 billion euros. And for context, DHL is the dominant player in Germany, which delivers 62% of all letters in 2019. However, only 33% of the group's profits came from Germany, with DHL Express being the world's largest provider of premium parcel delivery. At the moment, it's trading at a price to earnings of 15.2, with a prospective dividend yield of 3.2%, and its market cap is 63.1 billion euros. Sam, I mean, this is a company that I'd never looked at before. I think mainly because it's been sort of European listed, but it seems to be, one of those companies that has benefited a lot from, I suppose, lockdown and the online or the increasing trend for online shopping and online delivery. Were you impressed by these numbers?
I was, yeah. And guess like you, I've never looked at it before, but it's not going to grow at 22% a year, is it? But PE of 15.2 with a 3.2% prospective dividend yield, it doesn't have to. And that being said as well, I think the amount of internet penetration for retail, it's still quite a small proportion. So although it's not going to be growing at 22%, I do think it will continue to grow, I'd say, for a long time to come. So at 15 times earnings, I understand that the German, it's basically like the German equivalent of Royal Mail as well, isn't it? So I understand that position, that part of the business is going to be declining, but that only makes up quite a small percentage of it anyway. So to me, it looks very reasonably priced, and that's despite, I mean, in the last year, I mean, it's almost doubled. It's gone from about 26 to 50, and it's basically an all-time high now. And I still think it looks quite reasonable. What about you?
That was my impression. I thought with those numbers, I was expecting it to be trading at much higher multiples, but it wasn't. And yeah, I think in terms of the long-term trend, I'd be quite confident with it. And you wonder whether the sort of almost the legacy side of the business, a bit like the Royal Mail, would just sort of die out anyway with the letters.
It doesn't matter anyway, though, because if domestic post and parcels is only 33%, and even then the mail's only going to be a proportion of that 33%. It's not in any way a large part of the business, is it?
No, that's right. And I mean, it is a global player that, I think it's attractive. I'd definitely look into it further. I think it's one that is going on my watch list for sure.
No, I mean, even if you assume that growth, I don't see it shrinking. But even if you were really pessimistic and said the growth's going to drop down to zero now, it's still attractive. And I don't think it is going to drop down to zero. I think it's probably going to be single digits, but I think it's going to be probably like mid-single digits. That's probably where I'd expect it to be over the next, decade.
I'm disappointed it wasn't on my watch list around March last year, because there were certain companies that I did buy, but I think this could well have been one of them had I known about it.
Well, now, and it's still cheap, isn't it?
Yeah, absolutely. It's not to say that I wouldn't buy it at the current price. It warrants further investigation anyway.
No, I'm very impressed with it as well, actually.
Yeah. So that's a bit on DHL, or an introduction to it, something that I'm sure we'll be revisiting. Now, another online company, Trainline, so obviously UK based this time.
They've come out with their full year results. It's a company we looked at before. It must have been the interim results we looked at last time, because I think it was about 6 months ago. So the interim results weren't very pretty. And unfortunately, the full year results aren't any better. So net ticket sales were down 79% to 783 million. Revenue was down 74% to 67 million. Adjusted EBITDA was down 110% to a 25 million loss. Operating profit was down 102% to a 100 million loss. Operating free cash flow was down 205% to a 146 million pound outflow. They did highlight that the UK industry e-ticket penetration has increased during the year from 21% to 30%, and that approximately 70% of all e-tickets are sold through Trainline. So I guess if that penetration was to remain when things bounce back, which I don't see why it wouldn't, I suppose that's quite good. For the UK consumer side of the business, it said that net ticket sales decreased to 473 million, which is at 23% of the prior year level, reflecting the effects of COVID-related lockdowns over the course of the year. Net ticket sales peaked in August between the first and second lockdowns at 46% of the prior year versus wider industry passenger volumes of 34%. UK consumer revenue declined to 44 million, which was 25% of the prior year, driven by the material decline in net ticket sales. Revenue take rates was distorted upwards by a significantly higher number of refunds in the period, partly offset by a lower mix of customers from overseas who tend to generate higher revenue per transaction. Cost of sales reduced to £10 million, which was 29% of the prior year, given reduced transaction volumes, partly offset by an investment in customer services to process the unprecedented levels of refunds arising due to government lockdown measures. Gross profit decreased to 34 million, which was at 24% of the prior year. And in the international segment, international ticket sales were 235 million, so that compares to 473 million for UK, which was 48% of the prior year. This was better than UK, given earlier and more prolonged relaxation of restrictions in key European markets in Q2, within which Trainline's 3 top domestic markets in Europe, France, Italy, and Germany, returned to year-on-year growth. With further COVID-19 lockdowns in the second half, demand fell back across all the markets. While timing of recovery remains uncertain for the international business, we continue to invest in our product roadmap to be ready for recovery when it comes. And revenue decreased to 11 million, which was 43% of the prior year, given the reduction in net ticket sales. As with the UK, international take rate was impacted by a lower mix of customers from overseas who typically generate higher revenue per transaction. Cost of sales decreased to £5 million, which was 54% of the prior year, given the reduced transaction volumes, and the gross profit reduced to £7 million, which was 38% of the prior year. Net debt increased to £241 million at the end of February 2021, which was up from £71 million a year before, primarily as a result of the negative operating free cash flow. And they've said the liquidity position was significantly bolstered by the issuance of £150 million of convertible bonds in January 2021. And there were a few interesting points in the slides. So they've said they've mitigated the impact of COVID-19 by reducing the monthly cash burn to £5 million, which has increased the liquidity to £260 million. They've highlighted that in terms of long-term tailwinds, the domestic flight ban in France has been announced for routes less than 2.5 hours travel by train. And there's a joint action plan in Germany between aviation and rail industries to encourage people to switch to rail. And they've said that pre-COVID, about 86% of flight tickets were sold online compared to approximately 40% of train tickets. And the e-ticket industry penetration in the UK is 30%, which was up from 14% 2 years ago. And they've also highlighted that new app customers, so this isn't revenue, this is just, I guess, number of people using the app, that's now at 80% of the pre-COVID level. And they've highlighted the efficiency of their marketing engine, and they've said that every £1 of Trainline advertising spend yields an incremental £11 to the rail industry. In terms of the valuation, you wouldn't know that revenue down 80%. So it's trading at a market cap of 2.11 billion and a share price of £4.40. And that compares to an all-time high of 545p, but that all-time high, it's within the past year it's been set. So it's basically where it was pre-pandemic, which, given revenues are down 80%, it's taken on more debt and it's issued convertible notes. Seems expensive.
What do you think about the longer trend towards rail travel and the sort of the business model of Trainline within that?
In terms of the valuation, it's obviously it's basically pre-COVID levels, but that puts it at a price to sales of 31. But if you use the 2020 figures and take them as normalized for the 2020 year, you'd get a price to sales of 8. Normalized gross profit margin 77%. And 2019 to 2020 revenue growth was 24%. However, if for example, the e-ticket sales were to increase to a level that's in line with air travel, I'd expect it to maybe be a bit lower because you don't turn up at the airport really and just buy your ticket there and then. So it's never going to be the same level. But, even if it gets to say 60% instead of 80%, that's basically doubling the business. So you can sort of see how people are like rationalizing the valuation. But I just think there's a lot of unknowns. And, given revenues are down 80%, it just seems very, very optimistic.
And would it worry you about the government being more involved in the rail and whether sort of things were sold directly and whether they try to cut out or exclude Trainline from, I wouldn't say profiteering, but making money on the back of, I don't know whether you'd say reselling, but selling the train tickets via their app?
It would, yeah, because if they've got 70% market share of the e-ticket sales and say that actually gets to the point where it's, let's say 60-70% of all tickets are sold through that, at some point you would expect the margins to start to come under pressure, whereas like when it's 20 or 30% and they're trying to get more people doing e-tickets, they're obviously willing to pay that. But yeah, I think that would be a concern as well. It's an interesting business, but when it's down 80% year over year, for it to trade at pre-pandemic levels, it just seems ludicrous, really. And then in addition to that, they've actually had a new CEO come in this year. So it's not ideal. There's no reason to suggest the new CEO is going to do a terrible job. But it's not ideal, is it? It's not.
No.
Yeah.
I think for that reason, for the reason that the price it's trading at, considering the numbers, and I appreciate you may price in a bounce back, but also a longer term future, I'm just the regulatory side of it would worry me, I think. But could be wrong. I use it as a customer and I think it's a very slick app and I like what it does, but I don't know what its long-term future.
You use Uber as a customer, don't you? And it's a terrible business.
And Deliveroo, which is probably the one we disliked the most when we covered it a few weeks ago. So
you use it as a customer. It's basically a kiss of death, isn't it?
Could be. But yeah. So anyway, any further thoughts on it, Sam?
I guess really I like the business model. Regulation aside, I could definitely see, like the longer term trends of more tickets becoming e-tickets, and as people want to reduce carbon emissions, getting more travel done by train. There are a lot of things going for it, but the valuation just seems crazy. Like imagine if you bought it a year ago on the basis that there was going to be a global pandemic and revenues were going to be down 80%, and because of that you thought that you'd be able to make like 25% in a year or whatever it's up by 10% in a year.
Yeah,
people would have thought you were out of your mind.
Yeah,
but that's what would have happened.
Yeah, no. Well, we'll move on to another European listed company. This time it's the brewer, AB InBev, and it's probably most famous for Budweiser, but it does have a number of other famous beer and lager brands, including Corona, Stella Artois, Beck's, to name but a few. So they had their first quarter results out and they announced that revenue for the quarter was up 17.2% to $12.3 billion. In the North American division, volumes were up 2.9% and own beer volumes rising 1.8%. Revenue came in at $3.8 billion, which represented a 5% rise. And this reflected higher sales to wholesalers and slightly reduced sales to retailers. In Canada, volumes and revenues were in the low single digits. The Middle Americas revenue was up 16% to $2.8 billion, with total volumes rising 10.4% and own beer volumes up 12.2%. Cash profits came in at $1.4 billion, up 10.6%. South America saw total volumes up 12.1% and 15.1% in own beer volumes. Cash profits in that region up 23.3% to $763 million. Europe, the Middle East and Africa saw volumes fall 2.1%, with own beer down 0.1% and revenue was down 0.4% at $1.6 billion. Underlying cash profits down 14% at $403 million. And obviously Europe was particularly badly hit by bar and restaurant restrictions And South Africa had the sales ban on alcohol and tobacco, which continued. In Asia Pacific, volumes rose 63.3% and revenues were up 61.7% to $1.6 billion, with underlying cash profits coming in at $570 million, which was an increase of 166.6%. And notably, volumes in China were up 85%, which is well ahead of the overall market. The global export and holding companies saw a 70.1% increase in volumes, but underlying cash losses widened by 30.1% to $241 million. And debt is still very high. It's 4.8 times underlying cash profits. And that's largely due to the acquisition of SABMiller, I think back in 2016. The group are still paying a dividend. Price to earnings stands at 22, and that compares with a historic average of about 20. And the prospective yield on the shares is 1.4%. Sam, what do you think of the brewer?
I don't really like it.
Okay, what don't you like about it?
The numbers obviously seem fine. They said underlying cash profits to grow 8 to 12%, volumes up 13.3%. Like all the numbers look quite good. Yeah. I just don't like the industry really. I think people are drinking less beer, aren't they, globally? I think we talked about that when we looked at Heineken. Yeah. And that's not something that I like. I don't think it's necessarily like, they could still do well in a slightly declining market, and you just need to look at the tobacco companies for that. Yeah. But I'm a bit less able to comment on it because I don't really drink beer at all. But what's the difference between Budweiser and Heineken? There's just no moat there. I don't think it's not. And at 22 times earnings, I know it's growing like a decent amount in the current year, 8 to 12%. But a PE of 22 seems quite pricey to me.
I do quite like the brands. I think they do have strong brands, but yeah, I think you hear about Generation Z drinking less alcohol, and I think there's probably less pricing power with beers, despite having fairly strong brands in comparison with, say, a Diageo, where they can this sort of premiumization going on, and
or even a Fever-Tree,
not dissimilar. That's what I was about to say. And you combine your Diageo and your Fever-Tree, and I think that's a much stronger investment proposition than a pure play brewer. So, Diageo, for example, I know we're not just talking about Diageo, but that does have a brewing business to it with Guinness, but it also has, vodka and all of the premium spirits in its portfolio. So yeah, I'm not as taken by AB InBev as a proposition, despite having quite strong brands, primarily because it is just in the brewing industry, and it's impossible to know what the future trends are, but it seems to be a bit of a declining industry at the moment, or that seems to be the trend. So, and it's got a lot of debt on the balance sheet. It's not particularly cheap at the moment either. So I don't think it's in the best of health either as a company.
Yeah, I'm in agreement.
And obviously it's tried to consolidate with with the acquisition of SABMiller, but coming at a cost, I think, and I don't think they've really come to terms or addressed that yet. At the current price, it wouldn't be one for me.
Yeah, I think if I wanted exposure to the industry, I'd do it through Diageo. And if I was holding AB InBev or even Heineken, I'd be a lot more nervous holding that than I would be holding a Diageo. Diageo, it's almost a kind of company you could just go away and not look at it for 5 years, and I wouldn't be too worried when I came back 5 years later to have a look, because even though the trends are changing, some will go for it, some will go against it, as long as the whole industry is doing okay. Whereas with like AB InBev or Heineken, it's rising and falling with lager, isn't it?
It is, and I think that's the bigger worry. But no, it's one I'll keep an eye on, and I'd be interested to follow, but not one that I'd be investing in.
No. Should we move on to our final company then?
Yeah. So what have we got last, Sam?
We've got Peloton last. So
okay,
I'm assuming most people.
So much healthier.
Yeah. So I'm assuming most people have heard of Peloton. They make the bikes that everyone's been using instead of gyms in the past year. So they have come out with their Q3 results, Connected fitness subscriptions grew 135% year over year to 2.08 million subscribers, and paid digital subscriptions grew 404% to approximately 891,000. Total members grew to over 5.4 million. Q3 total revenue grew 141% to 1.262 billion. These figures are all in dollars, by the way. Q3 connected fitness subscription workouts grew 239% to over 149.5 million, averaging 26 monthly workouts per connected fitness subscriber versus 17.7 in the third quarter a year ago. Q3 average net monthly connected fitness churn was 0.31% per month, and the 12-month retention rate was 92%. Q3 gross margin was 35.2%, and of that, the connected fitness product gross margin was 28.4%, and the subscription gross margin was 64.6%, and the subscription contribution margin was 68.4%. There's a net loss of $8.6 million, which worked out at 3 cents per share. And they've said EBITDA was 63.2 million, representing an adjusted EBITDA margin of 5%. So they've also highlighted the average wait times for the original bikes are now back to pre-COVID-19 levels. They've highlighted the monthly average workouts per connected fitness subscriber reached new all-time highs. And on March the 8th, they announced their plans to expand into Australia. They've highlighted that operating expenses grew 51% year over year to 458.6 million, which is significantly lower than the revenue growth. Total platform workouts grew to over 171 million, up from 48 million a year ago. And live workouts grew to 2.8 million, up 30% from the second quarter and up 115% year over year. As of 31 March, 98% of their connected fitness subscriptions were on month-to-month payment plans. And in Q3, the average monthly workouts per connected fitness subscription was 26, which represented 47% year-over-year growth. Operating expenses equate to 36.3% of revenue, and of that, sales and marketing equates to 16.5% of revenue. General and admin is 14.3%. And R&D is 5.5%. It's talked about in the earnings call, but really it goes hand in hand. So they're predominantly known for the bikes they do, but they recently launched the treadmills, and the treadmill launch didn't quite go to plan. So I'll just read straight from a Financial Times article.
Okay.
Peloton said it expected its voluntary recall of up to 125,000 treadmills to cost 165 million as it ceases taking orders, cancels any deliveries, issues full refunds, and waives 3 months of subscription fees to anyone who keeps their machines. The fitness equipment group recalled the treadmills on Wednesday following reports of injuries and 1 death. CEO John Foley, who came under fire for initially rejecting regulators' warnings about the treadmill, apologized for earlier inaction and said he would rather take some short-term plan to prioritize safety and future investment in the brand. For anyone keeping the machines, a software update in the coming days will lock the treadmill's belt when it is not in use to prevent incidents in which pets and children have been pulled under the machine. So they're recalling those. My view were... so one thing that's worth highlighting, the gross profit percentage is obviously very low, but that's because the sale of the devices make up the majority of the sales at the minute, and the higher margin subscription revenues are lower proportion. And I do think that will change over time. I actually think the treadmill is not really a huge problem. I do think that what is being described as the issue to me sounds like an issue with any kind of treadmill, really. I don't see how it differentiates and how. So really, to me, it just seems like it's no more dangerous than a normal treadmill.
Do you think it's just got more media attention because it's Peloton?
I think so, yeah. I mean, like, how are you more likely to go under a Peloton treadmill than a normal treadmill if you're not using it properly? I mean, it does the same thing, really.
I honestly, I don't know. I don't know what safety mechanisms ordinary or conventional treadmills have, in comparison with the Peloton products.
Well, they've said they're putting the pin on it now, and I'd be surprised if most ordinary treadmills have a pin. I don't think they do.
Yeah, no, I
Other
mean,
than
I'm
that,
not,
there's
I'm not
nothing
someone who really,
there's
yeah.
not really much you can do. Like it's just how the machine works. But
Moving on from the treadmill side of things, what do you think about the longer term trend of sort of exercising from home? Obviously that COVID, I'm sure, boosted that. Do you think that's something that's likely to continue as people go out and about, perhaps return to conventional gyms more?
I think there's people who are going to go back to the gyms, but in terms of how people are going to exercise in 10, 20, 30 years, I think you're going to see more and more people exercising at home. And I just think in terms of the long-term trend, I think it's going to continue moving in Peloton's favor. In terms of the valuation, it's down about 50% from its peak. And it's now trading at a market cap of 24.68 billion. And that puts it at a price to sales of 8.3, although that price to sales is quite low just because the bulk of the revenue is from the lower margin devices. However, obviously we talked about this a couple of months ago now in the conversation with Flosser, and in terms of the penetration, it is a lot lower than where it could be. They're not in a lot of countries and they've only got a handful of products at the minute. And when you look at the full range of gym equipment, if they take that brand and apply it to a lot of other machines, people will buy them, I think. And in terms of the subscriptions, I mean, how many subscriptions can they actually get? That's like the key question. But I mean, where it's a few million at the minute, I think the ceiling for it, given the power of that brand and just the trends in its favor and how well it's operating at the minute, I think it's a lot higher. And if you just play around with the numbers, so if you say that they're going to get 20 million subscribers as the final figure, which I think is actually quite low compared to what it could be, and say they're all paying $15 a month, that'd give you annual revenues of $3.6 billion. But if you assume that there was going to be a net profit margin of 25% on that, that would put it at a PE of 27 for the current valuation. And that's with, I think, quite conservative estimates in terms of the pricing and the number of subscribers. And that assumes they're not selling any hardware, which they're going to, and that's going to contribute profit as well. In terms of the net promoter score, it's second only to Tesla. And I do think the people who have it, they are absolutely fanatical about it. And to me, I think if you look at where it could end up and try and look at like how many subscribers could it actually get, I think the current market cap looks very reasonable. What are your thoughts?
I mean, you're selling it to me, but I think, yeah, I don't know whether I'd be brave enough to go in with some, well, first of all, the valuation, and then I suppose some of the concerns about the safety of it. And I probably don't have the same conviction about the future of the brand and whether those sorts of trends that you mentioned are likely to continue. But I can see, I mean, obviously if they do, then it could be considered cheap, I suppose. But on conventional metrics, it doesn't look it.
Would you ever buy a Peloton?
I'd like to try before I buy. Near where I live, actually, they do have a Peloton store. So I think you can go along. So maybe I'd have a look at some of the products there and have a go, see what it's like. But probably stick with the conventional gym membership at the moment. Would you?
I probably wouldn't actually, just because I like to listen when I row. I like to listen to podcasts. So I don't want some like instructor shouting at me because then I can't listen to my podcasts. Yeah, I quite like choosing what I listen to when I exercise.
Do you think you'd do more exercise having that sort of almost that personal trainer instructor there that obviously Peloton supply, part of the Peloton brand?
I don't know. It's a good question.
Because
I mean based on the numbers that they give, the answer would be yes.
Yeah. Because I mean, that's one of the things, the reason that you might go to a gym, you might have a personal trainer, or you might buy a Peloton is because you've got that motivation to do it rather than buying a rowing machine and not using it, for example.
And as well, one thing I forgot to mention is it is a slick piece of kit. And I don't think it's outrageous to think that they could be selling a lot of these pieces of kit in the future and have Apple-like margins on them. Because in terms of the net promoter score, it is at that kind of level. I mean, this second only to Tesla.
Yeah.
It's obviously like there is a lot of risk baked in, but it's kind of like if you look at like if they were operating in most developed countries and you looked at how many monthly subscribers you'd expect if they were the dominant global, kind of like the Netflix for gyms, how many would you expect? And you don't need that higher number, I think, for the current valuation to look very cheap, because 20 million worldwide, that is quite low compared to potentially what it could be. I know that like it's not gonna be like Netflix where like every household has it. And I know Netflix has like 200 million subscribers. It's not gonna be like that because people are like less people will want to exercise than that. But you could still have quite a reasonable proportion, and the numbers look very cheap, I think.
Yeah. So out of the companies today,
so Boohoo, Novo Nordisk, Deutsche Post, Trainline, Anheuser-Busch, and Peloton. See, I was actually when I was doing the prep, obviously Deutsche Post was one of your ones. So I hadn't looked at it as much. So I was going to say Peloton. That was like what the conclusion I'd come to. But
they are different.
I do like Deutsche Post. I'm going to stick to my guns and go with Peloton. But Deutsche Post, I do like the look of that a lot.
Yeah.
What about you?
I'd probably go for Deutsche Post as number one, and then I'm becoming more and more interested in Boohoo and ASOS. So I think that would be my second, but Deutsche Post would be the one for this week for me.
What would be last?
AB InBev, maybe.
Yeah, I'd have gone with Trainline.
Oh, actually, God, sorry, I forgot about Trainline. Trainline, actually, by far and away.
I'd always probably go for the business that's got revenues down 80% last.
Yeah.
So I think that's everything then for this week, unless there's anything you want to add.
No, I think that's everything. Well, thank you very much for joining us, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.